Welcome to the Abacus Unlocking Business Growth webinar series. I am excited for you to join us today. Apologies for us having to delay this. I had some stuff going on last week on Friday, which I could not rearrange and sort out. So we had to push our August webinar to September. Okay, so for those of you that have joined us on the Zoom call, we are streaming live to Facebook, and we will stop that at the end. We'll stay on the Zoom call then to do some question and answers if you have any. For those of you that are watching us live on Facebook, welcome. Thank you for joining us. If you want to jump onto the Zoom call, if you want to just put a comment in the box, we'll put the link down there so that you can also answer questions. We can also answer your questions at the end. Okay, well, my name is Kerry. I am the owner and CEO of Abacus Business Solutions. We are in our 11th year of business, and we are located in Central Florida. We help our clients to know, understand, and trust their numbers and to increase their profitability, because at the end of the day, that's what everyone is wanting to do. Grow the business, know the numbers, and increase how much money they make. Okay, so let's jump straight in. It is Friday, so I want to make sure that we are efficient with your time. So there are 5 topics on this screen, and we are only going to be covering the first 2 today. And that is because if I was to cover all 5 of these topics today, we'd be here for about 3 hours. And I'm sure you don't want to spend 3 hours with me on a Friday afternoon. So we're going to cover the first 2, and then we will cover the future topics in other webinars in the next couple of months. So today we're going to talk about understanding your numbers and going to talk about cash flow mastery. Okay, so let's jump in. Okay, financial jargon. So you are a business owner. You started your business in the area of business in which you are an expert. You didn't start in an accounting and bookkeeping business because you're not an expert in numbers, and that's not something that you enjoy doing. You started your business doing whatever your business is. And so nobody is expecting you to be an accounting expert. No one's expecting you to be a bookkeeping expert. And so the fact that you may not know this terminology is totally okay. We're not expecting you to know that. And if you find sometimes that you're talking to your accounting professional or you're to someone in your bookkeeping team and they're using all these words and you're like, oh my gosh, like I have no idea what they're talking about here, and you're feeling very overwhelmed, then I don't want you to feel bad about that. That is just something where you have to make sure you have the team working with you that you feel comfortable with asking those questions. So that's why we wanted to cover a little bit today of some of the jargon you might be hearing. We won't be able to cover all of it because I'm sure there's going to be other stuff that maybe is being thrown at you and it's overwhelming. But we're going to go through some of the ones that you really need to be able to understand to help you understand what your reports are telling you. So we're going to talk in a second about the financial statements. So we're going to talk some of the terminology that you're going to see on those financial statements. So first one thing we're going to talk about is assets. So that appears on your balance sheet, and your asset is basically everything that the business owns. So that's equipment. It will be trucks, so any vehicles your business owns, any trailers, any equipment that you're using on your job sites, anything like that that is of significant value, normally between at least a minimum range of $1,000 to $2,500, depending on who you're working with as a tax professional. Everything that you own as a business is an asset to your business, including the cash is in your bank account. So whether that's checking account, savings account, whatever accounts, if you're following the profit first method and you have all those different accounts set up, those are all your assets. So everything the business owns. So if at the end of the day, you close the doors, you've got your cash in the bank, and you can sell the assets of the business, you can sell the equipment, the vehicles, etc. And then also your accounts receivable. So that is what your customers owe you. So that's also an asset because that is money that is due into you. So that's an asset of your business as well. Okay, so the next one, if you're thinking about assets, you normally hear the word liabilities. So liabilities are those debts and those obligations that the business owes. So that is money that you owe to somebody else. So that might be a loan on vehicles. It might be a mortgage on a property that the business owns. Credit cards, that is a liability. So anything you owe on your credit cards, that is going to be a liability that's going to show on your balance sheet as well. And then also, of course, we talked about accounts receivable being an asset. So then you've got accounts payable then being a liability. So the vendors that you owe, the payments you owe to your vendors for services and products that you have purchased, that is a liability because that is money that is due to them. So that is the main thing, difference between your assets and your liabilities. What you own is an asset, what you owe is a liability. And then the other term that you will see on your balance sheet is equity. So this is the business owner's stake in the business. And so that's calculated assets minus liabilities. So at the end of the day, if you had to close your doors, you would have all of your assets, you would collect all the money that was owed to you, you could sell all of the equipment and vehicles and everything, you would pay all your liabilities, and the difference then is what you are left with. And that's obviously where you want that to be in a positive number so that you are making some money on that. So another term you might hear is depreciation. I know this is a term that people are like, oh, what is that? I don't get it. So depreciation is the reduction in the value of an asset over time. So particularly relevant, when you're in construction and you've got all these vehicles and equipment and machinery. And so if you think about it, if something appreciates in value, it goes up. If something depreciates, then it goes down. So if you think about the truck that you buy today for $50,000, if you come to sell that truck in 5 years' time, then you are not going to be able to get $50,000 for that. It's going to have depreciated in value. So the depreciation is an expense that we record on the profit and loss, and then we show that accumulation of that on the balance sheet over time. And then let's talk about cash flow. That's a term that people hate to hear, cash flow statements, and just get very overwhelmed and confused by it. And this is how I want you to think about it. Cash flow is the movement of money in and out of the business. That's it. It's the movement of cash in a business. If you have a positive cash flow, then you have more money generating and flowing into the company than you have flowing out, which is obviously the direction that you want to be going in. Those are just a few of the terms. We're going to cover a few more on the next slide, but those are the few that I just wanted to go through initially. And the reason it's so important that you understand the financial terminology is this is where it's helping you to make those informed financial decisions. If you've heard my webinars before or been on any of my lives, you know that that's one of my favorite phrases, informed financial decisions. Excuse me, I'm covering for a cough, so I'm going to have to take breaks throughout this. Okay, so you don't want to be making business decisions based on a gut feeling or based on your bank balance or based on what somebody else is telling you. You want it to be informed. You want to be looking at your numbers, being able to understand what they're telling you, and then make that decision as to what is the best thing to do for your business, what makes sense as the next step. And then also having an understanding of this terminology helps you then to have effective communication with your accounting team, with other stakeholders in the business, with lenders, with financial advisors. If you understand what those reports are telling you, then this will be able to help you understand what is being advised to you, what people are asking of you. So financial jargon, don't get overwhelmed by it, but make sure you have that understanding so that you know exactly what your reports are telling you. Okay, so financial statements. So this is where we're going to talk about your balance sheet, income statement, also known as the profit and loss statement, and the cash flow statement. So let's first talk about what is the profit and loss report. So that is a report that is based on a period of time that is letting you know what your sales were and what your expenses were and what it had left at the end. So profit and loss might be, so for example, we just hit September 1st. So, in the next couple of weeks, hopefully you're looking at your profit and loss report or your income statement from August 1st to August 31st, maybe January 1st to August 31st, looking at year-to-date figures. So it's a period of time that you're looking at. The balance sheet is different. The balance sheet is a snapshot in time. So I like to think about this. If you take a photo, you get that photo of that second in time. And then after that, everybody's moved in the photo and you're never going to get that moment back. And that's what your balance sheet is like. It's telling you exactly at this period of time, this is how much money you have in your bank account. This is how much you owe on your credit cards. This is how much people owe you. This is how much you owe people. That could change 20 minutes later if somebody runs a debit card transaction through or a payment to a credit card is recorded. So that's why it's just a snapshot in time looking at the balance sheet. Profit and loss is a period of time, balance sheet, snapshot, just like that. So profit and loss, so that is showing you at the top, you've got your revenue, sales, different terminology for it. But that's how much money that your business has made. That's going to be recorded at the top. And then you've got your cost of goods sold. So not every business is going to have a cost of goods sold. For me, for example, in the service industry, I don't have a product that I'm selling. So I don't have a cost of goods line item on my balance sheet. If you are selling a product, or a combination of products and services, then you're likely to have that cost of goods sold on there because you want to know how much is that sale costing you. And then after that, you're going to have your gross profit. So your gross profit is your revenue less your cost of goods sold. Underneath your gross profit, then you have your operating expenses. So this is where maybe you got your payrolls or your salaries and your employer taxes, your rent, your utilities, health insurance costs, anything like that is an expense to the business that cannot directly be attributed to a particular job is going to appear in this section here. And then at the end, when you take your gross profit and deduct those operating expenses, you're left with your net profit. Okay, so that is your profit and loss report. So it's really important that you understand what your profit and loss is telling you, and not to get confused with, excuse me, oh, my profit and loss report tells me that I made $50,000 in net profit. Why don't I have $50,000 in the bank? Like, how can I have made $50,000 if I don't have that money in the bank account? So that's where the two reports play together, because on your balance sheet, if you're making credit card payments, if you're making payments to loans, those payments, or if you're drawing money out of the business as the owner, that money leaving the business is not reflected on the profit and loss. So that's why just because your profit and loss says you're profitable at $50,000 doesn't mean you're going to have $50,000 in the bank account, because that is where out of that profit, you have also then paid the loan payments, the debt payments, the credit card payments. And so that's why that number is going to differ as well. So that's where I know people get a little confused. They'll say to the tax pro at the end of the year, like, the tax pro's like, hey, you made 50,000. And, the owner's like, what do you mean? I don't have 50,000. That can't be right. So that's where those differences, come from. So with this, when you're in the construction trades industry, understanding your profit loss is really, really important. And that's where you want to make sure that, how profitable is each job? What is it that you can be doing to make sure that you're making money on every single job? So you need to be tracking all these expenses. You need to know exactly where every single dollar in your business is going to. So the balance sheet, like we said, that's a snapshot in time of your financial position at a specific point. And that's where it's detailing the assets, the liabilities, and the equity that we just talked about a few minutes ago. So you're also going to have another sort of part breakdown as well into those assets, which are current and long-term assets, and then also liabilities, your short-term and your long-term. So basically everything is current if it's going to be recognized within a year. So if it's a debt you're going to pay within a year, like a credit card, then that would normally be considered a current liability. If you have a 5-year loan on a vehicle, then that's going to be a long-term liability. So the reason that this is really important for you to be able to see it, because this shows you what is the liquidity of your business. What is the overall financial health of your business? How much money are you owed? How much money do you owe? I have a client right now who owes $300,000 more to his vendors than his customers owe him. And I'll talk a little bit about that a little bit later on as well. So you want to make sure that you are in that positive equity, that once you've sold all your assets and you've got that cash in the bank and you've paid all your liabilities, that you still have a positive number after. That is the ultimate goal that you need to be aiming for. And that's why it's really important that you're looking at these statements and these reports every single month. Okay, still with me? So let's now talk about the cash flow statement, everybody's least favorite report. And this report can get confusing because you're looking at money coming in and out, coming out from different sources, paying different things, and it just can get very overwhelming for people. But like I said before, look at it as money flowing in and the money flowing out of your business over a specific amount of time. So you may have money flowing in maybe from an investor or from a loan that you took. That's another way that money is going to flow into the business, as well as sales. Money is going to flow into the business from your accounts receivable. So when your customers are paying you, which might be 30 days after you have done the job, that money is coming in. And then you're going to have money going out to your accounts payable. Again, maybe 30 days after you got that bill, the money is then flowing out. Maybe you're taking an owner's draw, and that's money flowing out of the business. So you've got all these moving parts that you can't just rely on the profit and loss or just the balance sheet to give you that information. This is kind of cash flow statement, is kind of like a merging of the two that brings you all the information together. Okay, so I hope that made sense. I hope that's giving you a little bit more clarity on the difference between your reports. Okay, so now we are going to talk about key performance indicators. So you may have heard these referred to as KPIs. And so this is another area that people get very confused with, but there's a lot of great information that you can get from these. You just have to take the time to understand what they're telling you and how this is impacting your business. So we're just going to cover a couple here. So the gross profit margin. So this is a metric that shows the percentage of total revenue that exceeds the cost of goods sold. So it's a measure on the profitability of your project. So obviously something that is an important number to you to make sure that you are, being profitable in your job. So if you're charging $10,000 for a job, it's not costing you $12,000. So to calculate that, you're going to take the total revenue minus your cost of goods sold, and then divide that by your total revenue and multiply that by 100. So the reason you want to be looking at this is because a declining gross profit margin might indicate that you've got rising material costs, maybe inefficiencies in your labor in the field, or you're going too low on your bids as well. So this is something you want to be measuring over a period of time and making sure that this is not in a continual decline. Okay, job costing. So I mentioned that a little bit earlier. So a lot of people, they don't like the phrase job costing. So let's not think about it as job costing. Another way to look at it is like a little mini profit and loss report on a job. How much money did you charge for this job? How much did this job cost you? How much money did you make on it? That's job costing. How much, it's just typing down into the individual job to make sure that you are making money. Because again, we're not in the business of going in, charging $10,000 for a job, and then, it costing us $12,000. That's not going to keep you in business very long. You want to be able to be charging $10,000 and it's only costing you $8,000. Make sure you've got those numbers the right way around. And that's why it's really, really important that you track all these expenses on these jobs, that you make sure that you are able to, tell which jobs are making money, which jobs did you lose money on. And then that's where the analysis comes in after. That's when you have to ask, okay, what went well on this job? How did we make so much money? Or, okay, what didn't go well on this job? Like, where did we lose money? What happened? Maybe there was some additional work that didn't get invoiced. There could be a lot of different scenarios as to what that is. So it's really important that you look at every job cost report, a little, like I said, mini P&L, and determine what worked well, what didn't work well. Did we miss invoicing on some additional work? And then what can we do better next time? So it's really important that you do that, because that's how you learn. That's how you go back and say, okay, this was an amazing way. We did this differently this time. It worked out great. We got the job done a lot quicker. Let's make sure we do that going forward. So that's why it's really important you sit down with your team and you figure that out. Don't just start a job, finish a job, move on to the next job. Make sure that you are looking at all this information and using the data that it's giving you to be able to improve and do better next time. So with job costing, that, like I said, is tracking all the different revenue and costs associated with a specific project. So this is where we're looking at direct materials, direct labor, and then maybe a portion of your overhead cost is another thing to be adding to that as well. But you want to make sure you have enough margin in there to be covering that. So when you regularly monitor your job costs, that's really going to help you see where your inefficiencies are, and it's going to help you to prevent cost overruns. And it's something that you need to do on a good time frame as well. Don't be like waiting 3 months after a job is finished to go back and do the analysis. You need to be doing it as soon as all those costs are in and looking at it there and then. So if something did get missed and not invoiced out, maybe the customer added a change order to the job, that you catch that sooner rather than later. Okay, so we're just going to cover a couple of those there. So I want to make sure that you understand there's lots of different KPIs, lots of different ways that you can use them, and it's something worth digging into a little bit more. Okay, so that was the first topic. I told you we're already 22 minutes in, so let's get moving on to the next one. So cash flow mastery. Okay, so obviously there's a lot of different challenges that are facing the construction industry. One way that we like to help businesses to increase their profit and ensure that profitability is to implement the profit first method. So this is where you are using multiple bank accounts to basically tell your money where every single dollar is going. What is this $1 being used for? What is its purpose? Okay, your purpose is for payroll. Your purpose is to be used for profit. And it's really important that you are in control, that you're not just operating with one bank account. If you have one bank account, that's your operating expenses, all your money comes into that bank account, and then all your expenses go out of that bank account, you're really doing yourself a disservice, because you're not able to see exactly where your money needs to go. You're spending the profit without even realizing it. You're spending money that should be going to taxes without realizing it. You're spending the money that should be going in your pocket, as owner's compensation, without realizing it. So when you set up multiple bank accounts, like for my business, I think I'm up to 12 bank accounts, which I know I'm not telling you need to go out and open 12 bank accounts, but that's just how I have separated my money out to tell the money where it's going to. So for example, I have a payroll account. I have a team of people. They rely on me to pay them. And so at the beginning of the month, when our revenue comes in, I make sure that the money that's needed for payroll goes into that payroll account and does not get touched, does not get used for any other purpose except paying my team. The owner's comp account, that is to pay myself. When it comes down to it, when you have your own business, you are the most important employee in the business. And so if you're an S Corp, then you need to be paying yourself through payroll. If you're not an S Corp, then you need to be making a draw on the account. And you need to be making sure that you are being paid one way or another, depending on your tax entity setup. It can get really demotivating, really demoralizing really quickly if you're putting in hours and hours of work, you're paying your team, you're working so hard to bring in new business, to make sure everything happens, and then you don't pay yourself. That is just going to lead you down a path real quick to destruction and to hating a business and just giving up and quitting and going back and getting a job. So make sure that you're paying yourself. And this is one of the aspects I love about having these multiple accounts is you're making sure that you do get paid. Because, if you are not paying yourself, then, your spouse, your partner, family member, whoever you're staying with is going to get really fed up real quick and get negative about the business if you're not contributing anything. So make sure that you are paying yourself. So let's talk about the profit account and tax account. So the 5 accounts that we talk about are having the income, profit, tax, owner's comp, and operating expenses. So your income account is where all your revenue is going to go into. And then you're going to use allocation percentages, which talk about and calculate as to what would go into a profit account, tax account, owner's comp account, and the operating account. Now, the profit one, that's where your profit is going to sit, and you're not going to spend it. That's what we were talking about before when people say like, hey, my profit and loss shows me I made this much, but I don't have this in the bank. This is helping you to keep that in the bank so you don't spend it on other things. So we're putting money aside for the profit, taking our profit first. The next account we talked about is tax. So I've had people over the years say to me like, hey, I don't want to make any money because I don't want to pay taxes. And I look at them and I'm like, what do you mean you don't want to make any money? Like, didn't you start a business to be profitable? Well, yeah, but I don't want to pay taxes. Well, I say to people, paying taxes is a good thing because it means you're profitable. It means you're making money, and that's okay. The difference is, and the key is, making sure you're putting that money aside to pay those taxes. And if you're profitable, then you have that money. It just means you have to put it into a separate account so you don't go spend it. So paying taxes is a good thing. Now, I don't agree with overpaying taxes. So you want to make sure that you're working with an experienced tax professional that can make sure you're paying the least amount of taxes legally. But paying taxes is okay. Just make sure you save for it so that when your CPA or your tax bro calls you and says, hey, you owe $10,000, you're like, okay, got it. It's in my tax account. I'm good to go. Cut a check, go online, pay it, whatever. It's done. There's no stress. There's no fumbling. There's no trying to pour this money together. So that's the difference. Putting your profit aside, putting money aside to pay the tax on that profit. It's okay to pay taxes. That's what keeps the country going. Owner's comp we talked about, making sure putting money aside to pay yourself. And then everything else is going to operating expenses. And then if you choose then to have different accounts open, like your payroll, then that's money comes from the operating expense account. If you have sales tax on your product that you're selling, then have a sales tax account. Put that sales tax money into a separate account so you don't spend it. It's not your money to spend anyway. You're collecting that on behalf of the Department of Revenue. So don't keep it in your operating account. Get it out of there and put it into your sales tax account. Another account you might want to have is payroll, like I was talking about. My payroll money is all put aside at the beginning of the month. Another account you might want to have, particularly in construction, is for materials and subcontractors. Again, you're collecting that money from the customer on behalf of that material supplier, on behalf of that subcontractor. It's not your money to spend. So make sure that if you have that material and subcontractor account, when that money comes in, you put their share into that material and subcontractor account and then pay them out of that account. I know I just threw a lot of information for you then, so make sure you stay tuned to the end, and I've got a way to help you with that. Okay, so that is one way that you can help yourself, is to use the multiple accounts, tell your money exactly what it's to be used for. So another aspect is milestone-based billing. So your progress billing. Don't be just waiting till the end of the job and then invoicing the customer for the whole job. I'm just having some decorating done at my house at the moment, and I got the quote from the painter, said, yep, that's great, let's do it. And he said, okay, great, I don't want any money off you until we've done the job. I was like, okay, he said, yeah. I said, are you sure? I said, yeah, it's fine. And to me, I feel like, he made a mistake in doing that, because he has to go out and buy the materials. He has to go out and buy the paint. And, he should have taken a deposit from me so that he wasn't taking money out of his account to go and buy the materials for my job, excuse me. So it's really important that you think about the milestone billing in your jobs. Are you asking for deposit from your customers before you start the job? Are you asking for another payment, throughout the job? And then you may be a second payment depending on the size of the job, and then obviously the final payment as well. You're going to put yourself in a really difficult cash position if you are fronting all the costs. So make sure that you're thinking about this, clearly communicate that to your customers so everybody's on the same page with the same expectations. And just reduce that risk by spreading out those payments. Let's make sure that you're getting paid throughout the job and not waiting until the very end. And then finally, let's just briefly talk about inventory management. So if you are a company that holds inventory, you want to make sure that you're not tying up loads and loads of cash in inventory that's sitting on a shelf and that's not moving. So make sure you've got inventory controls in place. Make sure you're being efficient with what you're buying. Don't just buy everything because you feel like, oh, it's a really good price. If it's going to sit there and tie up cash and put a strain on your business, it's not worth the savings on that money. So make sure that you're not overstocking to the point that it's making day-to-day payments difficult because you have all your cash sitting on a shelf in a warehouse. Okay, everybody doing okay? We are nearly there. We just got 2 more slides to go. Okay, so just a little bit more on the milestones, upfront deposits, and invoicing, because this is a really important one that I wanted to jump into. So make sure that you're able to see in a job, specific milestones or checkpoints in a job that you can say, okay, this is a good point to invoice. This is another good point. Also, it helps your team to be able to see how far you are through that job. Okay, right, we're 60% job, but 60% complete. We're going to now invoice 60% of the project to the customer. So make sure the customer knows exactly what to expect. I had some work renovation done on another house, and we paid a deposit. I think we paid a 25% deposit. We paid another 50% when the job started, and then 25% at the end. So, okay, that was good. And I knew about that before the job started. Before I even signed and accepted anything, it was clearly stated into what my payments were. So when I got an invoice on the day that they started the work, it wasn't a surprise. I was expecting that to come. So make sure you're staying ahead. Don't put a strain on your cash flow, just to get a job done. Make sure you're getting that payment up front. This is really going to help you have positive cash flow. It's going to help make sure you're not draining your bank account, because if you've got a whole bunch of jobs that start at the same time and you're not collecting any money off those people, then you've got all these jobs that you're basically financing until the customer pays you. Don't put yourself in that position. Like I said, I was expecting to pay a deposit to this painter. I was quite happy with that, and he didn't want one. And I'm like, how many other jobs did you just start this week and that you're footing the cost for? So make sure when you're looking at your milestones, they're realistic, they're achievable, and they're aligned with the project's overall timeline and goals. So don't just kind of make something up. Create something that makes sense and gives you clarity and gives your customer clarity, and everybody is on the same page. Okay, so handling initial outlays before project payments. So again, ties into the milestones. So the initial outlay, we're talking about those upfront costs before a project even starts. So this might be material purchases, like we talked about paint with my painter, maybe equipment rentals, depending on what kind of industry you're in or what kind of job you're doing. Permits, maybe you have to go and get a permit that's a couple of $100 for, before you can even start the job. Then any initial labor costs that go into that. So if you don't get a deposit up front, so as soon as that customer signs, you need to be getting a deposit so that you can then start work on the job. that is going to have a huge cash flow impact if you are not getting any money up front and you're having to front all of that. So you want to really, really think about what should that be? Is it a 10% deposit, 20%, 25%? What is it that helps you to feel comfortable getting that money, feels comfortable now, okay, now I can go and get this without putting a strain onto my cash flow. And also it's getting a level of commitment from the customer as well. If they know they've got to pay up front, then that gets a real buy-in from them as well. So when it comes to your supplier, so I was talking about that client that I had earlier that owes $300,000 more in accounts payable than what he is owed. So what happened with him? He has 30 days that he gives his customers to pay him. He pays his vendor, his one main vendor, 90-day terms they gave him. So he was all excited, like, great, 90 days. But guess what's happening? He's getting paid after 30 days from his clients, and then he's got 60 days, so he has to pay the material vendor. Well, guess what? That money is gone by then. There was a period of time before we started working with him that he was just drawing money. He saw the money was in the account and he took the money and he took it. And now he's up to $300,000 over what he is owed. So that's what we're talking about, the assets and liabilities. His are upside down, back to front, however you want to turn it. He's got himself in a really difficult financial position, which we're now trying to help him to get out of. So extended payment terms might seem like a really good idea, but you have to be disciplined in making sure that when that money comes in from the customer, if you know, okay, this is for materials and this is for subs, get it out of your operating account and put it into that materials and subs account like we discussed earlier, so that you're not spending money that isn't yours. So terms are great, long terms are great. It involves a certain amount of discipline, though. You cannot go and spend that money that is not yours, that's due to a vendor. So you want to make sure that you are really, controlled. And this is where it comes into knowing your numbers, that when that money comes in, okay, how much of this is for a subcontract or how much of it is for materials? So I know some people, you are not able to get as much of a deposit as they might need for whatever reason. And so there are short-term options like your lines of credit to help cover initial costs. That can be particularly useful if you have a very large project with a lot of significant upfront expenses. So just make sure that you are factoring that cost of that line of credit into your job as well, so that you are maintaining that profitability. Okay, a lot of information. I know I just threw at you in 35 minutes, and that's why we're only covering 2 topics today and not all 5. So hopefully that information was helpful. Hopefully that was information that you can take into your business on Monday and be thinking about, okay, what do I need to do different? What do I need to do better? What do I need to change? What do I need to implement to help my cash flow position? What KPIs do I need to start looking at? There's a lot of different things that you can take away from this webinar that can really help you to get into your numbers, to know exactly what is going on in your business and how you can increase that profitability. But all of that information, like I said, I threw a lot at you in 35 minutes. It can be very overwhelming, and I totally get that. So if you are ready to make a change, if you are ready to do something, and don't worry, I'm not selling anything. So I just want to put that out there right now. I'm not selling anything today. If you're ready to make a change, if you are ready to, okay, you know what, I gotta start doing things differently. I can't keep going through the rest of 23 and into 24, doing the same thing, being strapped for cash, not paying myself, always worrying about money, always worrying about how much money I have in the bank, how profitable I am. If you've got all those things happening, then this is a time that you need to decide, okay, today is a today that I'm going to draw a line in the sand and I'm going to change something. I'm going to be different and I'm going to increase my profitability. I'm going to make sure I pay myself and I'm going to do what I can to help my cash flow. So today then is the time that you can book a free 30-minute Zoom call with myself and we can discuss what you have going on, what is it that you need to change, what's working, what's not working, and let's see if we're a good fit and if we can help you to increase your profitability, help you to understand your numbers, know your numbers, and be able to take your business to the next level. So if that's something you're interested in, here is a QR code for you to scan. So grab your phones, because I know your phone is sitting right by your computer right now, if you're not on it, and scan this QR code. This will take you straight to my calendar link and book a 30-minute call with me. Like I said, there's no commitment. I'm not selling anything. There's no commitment to have to buy or anything. let's just have a conversation. Let's see what you have going on. See if we can help you. If I can't help you, then I can put you in touch with somebody that can. And let's see what we can do to help you take your business to the next level. What do we need to do to increase your profitability? So let's do something about it now. Don't keep going through the same thing you've been going through and stressing about it and worrying about it and just feeling like you're spiraling and that you're going to have to close the business. You can still make a change. You can still do something different. Okay, well, thank you so much for joining us today. I am going to stop the live stream to Facebook now. So if you're watching us on Facebook, thank you so much for joining us. I really appreciate it. We are doing these every month. We are aiming for the last Friday of the month. This was a little bit of an exception today. So make sure you get signed up so you can join us on the Zoom call, and that way you can answer any questions. We can answer any questions that you may have as well. So thank you for joining us on Facebook, and we will see you next time.